Define key accounting terms. A business transaction is an economic event that affects the financial position of a company and can be measured reliably in monetary terms. Record keeping refers to the process of documenting these transactions in the accounting system so they can be summarized and reported. Transactions are recorded using debits and credits, which represent entries on the left and right sides of an account. Debits and credits are used in the double entry system so that every transaction affects at least two accounts, keeping the accounting equation in balance. Accurate record keeping ensures that financial information is complete and reliable. A journal is the first place where transactions are recorded in chronological order. After journal entries are made, they are posted to accounts in the ledger, which is a collection of all individual accounts used by the business, such as cash, accounts receivable, revenue, and expenses. Each account in the ledger shows all transactions affecting that item and its current balance. The ledger is used to prepare a trial balance, which verifies that total debits equal total credits. These records form the basis for preparing financial statements and help ensure that transactions are properly classified and summarized. Financial statements are formal reports that summarize the financial activities and position of a business. The main statements include the balance sheet, income statement, and statement of cash flows. The balance sheet shows assets, liabilities, and equity at a specific date. The income statement reports revenues and expenses over a period, and the cash flow statement shows cash inflows and outflows. An accounting period is the time interval covered by financial statements, such as a month, quarter, or year. Dividing business activity into periods allows performance to be measured consistently. Cash flow refers to the movement of cash into and out of the business during a period and is important for evaluating liquidity. Profit or loss represents the result of operations during an accounting period and is calculated as revenues minus expenses. Profit indicates that the business earned more than it spent, while a loss means expenses exceeded revenues. These measures help users evaluate performance, plan future activities, and assess the financial health of the organization. Understanding these terms is essential because they are used throughout the accounting cycle and financial reporting process. Demonstrate understanding of key accounting principles. Cash accounting and accrual accounting are two methods of recognizing revenues and expenses. Under the cash basis, revenues are recorded when cash is received and expenses when cash is paid. Under the accrual basis, revenues are recognized when earned and expenses when incurred, regardless of when cash is received or paid. U.S. GAAP requires the accrual basis because it provides a more accurate measure of financial performance. The accrual method allows financial statements to reflect the economic events of a period rather than just cash movements, which improves comparability and decision usefulness. The matching principle requires that expenses be recognized in the same period as the revenues they help generate. This ensures that income is measured accurately for each accounting period. For example, the cost of goods sold should be recorded in the same period as the revenue from selling those goods. This principle works together with the accrual basis to provide a realistic picture of profitability. Without matching, financial statements could overstate or understate income, making it difficult for users to evaluate performance correctly. Consistency and conservatism are important principles that improve the reliability of financial reporting. The consistency principle requires that the same accounting methods be used from period to period so that results can be compared over time. Conservatism means that when uncertainty exists, accountants should choose the method that is less likely to overstate assets or income. These principles help ensure that financial statements are not misleading and that users can rely on them when making decisions. They support transparency and credibility in financial reporting. Accruals, deferrals, depreciation, and amortization are accounting techniques used to apply the accrual basis properly. Accruals record revenues earned or expenses incurred before cash is received or paid, while deferrals delay recognition until the appropriate period. Depreciation allocates the cost of long-lived tangible assets over their useful lives, and amortization applies the same idea to intangible assets. These procedures ensure that costs are recognized in the periods that benefit from the assets, which supports the matching principle and produces more accurate financial statements.